The mortgage interest rates, that number who tells you how much interest you will pay on your 15 or 30-year mortgage when you buy a house, is actually a very important number, not to take for granted. When the rates are lower, things happen, and now that they're higher and rising, other very important things will occur. So, in this video, I will talk about the implications of the Fed's future hikes this year on mortgages and how you could land the house of your dreams. So, stay tuned. Hi there, my name is Jaime Shekaiben and I welcome you to my channel, The Foreigner in America, where I teach locals and foreigners everything they need to know about producing money, keeping the money, and multiplying it, specializing in the markets and real estate. So if you're someone like myself who loves money and wants to be successful and free, please subscribe to this great channel and hit that bell so you follow up on my 2 weekly videos. Also check out my blog, Instagram, and social media under the same channel name, and take a look at my book, which I will leave a link below for you to check out. So without further ado, let's begin. Interest rates have consequences for the wider economy, with the Fed moving markets across equities, bonds, and commodities. The Fed sets the federal funds rate, which is a key base interest rate that filters through banks and affects demand for bonds, stocks, and the economy in general. 8 times per year, the Fed sets the rate at the Federal Open Market Committee meeting. And that filters to the prime rate, which banks use to charge to users. So every time this happens and rates go up, it affects the cost of loans and mortgages and takes more income out of consumers and businesses, so reducing demand. The stocks of companies depending on consumer spending, like retail or hospitality sectors, get hit the most. Growth stocks also suffer as investors look for value in profitable companies to ride out the market volatility. So, when interest rates rise, the yield on a bond becomes less valuable. Fixed income securities lose their value with rises as the cost of not owning other interest rate tracking assets increases. So predicting the interest rate for the next 5 years is key to know what the markets will do. So, what affects the rate for the next year or two to come? The key indicator is inflation. As the Fed fights to reduce inflation to 2%, rates will continue coming in every couple of months. The expected Fed rate for the end of this year is 5 to 5.5%. What we don't know is how would that affect the real estate market and the mortgage market. As of the recording of this video, the rates for a 15-year mortgage stand at 6.5% and for 30 years at 7% with good credit. And you might be able to pay points or do something creative with your lender to lower it a little bit, but not too much. So, if the Fed is raising rates 8 more times in 2023 to control inflation, at least 25 basis points each, that means at 2% more to the federal funds rate. How will that translate to the mortgage industry? People are saying that mortgage interest rates are going to go to 10% very soon, which is an option, but at least, let me tell you, they will be between 8 and 9% by the end of 2023. So what will that do? It will break the already broken mortgage lending industry and put a lot of people without a job. Companies in all sectors, especially tech and consumer spending, are laying off 175,000 people every month this year during the Fed raises. So remember, it affects the stock market too. Companies want to balance the value of their stock by getting rid of people and adding dollars to the bottom line. There is so much you can cut or delay payment to save money as a business. But in reality, your biggest expense every 2 weeks is payroll. When someone is laid off, it becomes a savings for a company immediately, since the labor laws are horrible in America and don't require employers to give out severances. So, what should you do if you want to buy a house? You shouldn't wait. as prices are not falling greatly due to the lack of inventory. The prices of houses are subject to supply and demand, not really the federal funds rate. Yes, if the rates go to 8 or 9% in the next 12 months, less buyers will be motivated to buy. True, but builders are already slowing down. So less houses being built and less people buying them equals stability. In some areas of the country, you might see reductions of less than 10% altogether. While you wait for the price to drop for 5% more, your interest will rise 2% more and make that payment a couple of $100 more expensive. So your payment goes up and the price goes down, but you end up in the same spot, but waiting for the perfect market when you already have the money to put a down payment and you can afford the house with your income and expenses is a mistake. You will lose on equity, you will lose on higher rates, and you will lose on the house because someone else will buy it. Here, where I live, a house gets 5 to 10 offers when it's priced right. Then they end up selling it at asking or higher. Realtors are still making a business. It's Texas, baby, just not Austin. The next hot market to buy real estate as an investor is Florida. So don't overlook to buy good properties that will be very valuable in the next 10 to 20 years. Don't say, I didn't tell you. But remember, take control of your life and take control of your money. Thanks a lot for watching this video. If you enjoyed it and found useful information, give me a like, subscribe, and hit that bell so you don't miss any one of my 2 weekly videos as soon as they come out. So have a great day. Don't lose any money, and I'll see you next time.